Imagine a popular restaurant that decides to buy its own farm. By growing their own vegetables and raising their own cattle, they stop paying middleman markups. They control the costs, they guarantee the quality, and when they serve you a meal, they keep a much larger slice of the profit. That exact strategy works in the heavy infrastructure sector too. A company called Lumino Industries is currently raising 700 crore rupees in an initial public offering, and their entire pitch rests on this self-supplying approach. Lumino is split into two halves that work together. One half manufactures specialized cables needed for power lines. The other half is the construction crew building the grids and substations. Instead of buying cables from an outside supplier, they supply themselves. The immediate reason we are looking at them right now is what they plan to do with that IPO money. They intend to use the newly raised cash to aggressively wipe out their corporate debt. To figure out if their high profit margins can actually last, we need to understand exactly how this self-supplying model works in the real world. Let's look at where their money comes from. Roughly 70% of their revenue is generated by manufacturing those specialized power cables, while the remaining 30% comes from the physical construction of power grids. Supplying their own materials gives them a distinct edge over a standard construction firm. Because they don't have to pay a third-party vendor's profit margin, their total project execution costs drop by up to 2.5%. In the world of large-scale infrastructure, that is a massive advantage. But making cables comes with a serious risk. The primary ingredients are raw aluminum and copper, and the global prices for those metals are constantly fluctuating. If copper gets suddenly expensive, the cost to build a power grid shoots up. To defend against this, Lumino writes a specific mechanism into their contracts. If the cost of raw materials spikes, that extra expense is passed directly onto the client. Their own profit margin stays completely intact. By combining internal manufacturing with these protective contracts, they take the unpredictable business of heavy construction and turn it into a highly insulated, stable operation. This table shows Lumino's 8-year financial health. The revenue from operations row shows a 26% annual growth trend. The profit after tax line grows even faster, at 40% annually. Comparing profit against equity, Lumino generates nearly 25 rupees per 100 rupees invested. Right now, they carry about 384 crore rupees in total debt. However, they have earmarked 420 crore rupees from this IPO specifically to pay off those outstanding loans. When you eliminate debt, you also eliminate the heavy interest payments that come with it. That means a massive expense completely disappears from their ledger. After the IPO, Lumino will essentially carry no net debt. Every new rupee they earn from building grids will flow straight to their bottom line, rather than being siphoned off by interest payments to a bank. Their current backlog of signed contracts sits at 3,149 crore rupees. To put that in perspective, that is 1.5 times the total revenue they generated in the entire 2026 fiscal year. Their income is effectively locked in for the next few years. That massive waitlist is driven by a nationwide push. The Indian government is rapidly modernizing the electrical grid to handle the enormous power coming from large-scale solar and wind farms like this one. To win these specific government contracts, Lumino relies on a proprietary product called high-temperature, low-sag cables. This specialized technology allows utility companies to double the amount of electricity running through their existing transmission lines, completely avoiding the nightmare of buying new land to build more towers. They are providing the exact tool needed to solve the grid's biggest physical bottleneck. They have the right product available at the exact moment the government is spending heavily on the solution. But we have to look at the realities of building infrastructure in the physical world. The biggest hurdle is land. Local disputes over access rights can bring government projects to a grinding halt, which directly delays Lumino's ability to finish the job and get paid. Building massive power lines also requires a mountain of cash on hand to pay for steel and labor before the final government checks arrive. During a growth spurt in 2025, that need for daily operating cash actually outpaced the money they had coming in, leading to a temporary shortfall. Operating in heavy construction, government bureaucracy and delayed payments are a constant threat to their daily operations. This table compares Lumino to competitors. It is priced at 12.5 times its annual earnings, significantly lower than larger players. Furthermore, standard models suggest a 124 rupee fair value, but the IPO is priced at 82. This 34% discount provides a significant safety cushion. Lumino combines a self-contained supply chain, a track record of high returns, and a massive backlog of orders tied directly to grid modernization. And with the IPO funds wiping out their corporate debt, their profit engine is primed to run even faster. If you can handle the inherent delays and land disputes that come with government construction contracts, this company presents a high-efficiency entry point into the massive upgrade of India's power infrastructure. Imagine finding a business that grows its profits by free. They also operate as an EPC firm, which stands for Engineering, Procurement, and Construction. This means they are the actual construction crew out in the field physically building the transmission towers and installing the grid. To speed this up, they fly drones to map out the best routes for new power lines, cutting their survey time by 60%. Back at the factory, they use artificial intelligence to automatically scan the wires for microscopic defects, ensuring every inch meets the strict safety standards required by the national grid. This combination of high-tech construction and precise manufacturing has earned them specialized certifications that take years for new competitors to acquire. These pre-qualifications create a structural barrier to entry, protecting Lumino's profit margins from smaller, less integrated rivals. Let's look at the financial engine. Over the last 8 years, Lumino has grown its revenue by nearly 26% annually, while its actual profits have compounded at over 40% a year. This efficiency shows up in a metric called return on equity, or ROE. Right now, theirs sits at 24.6%. This simply means that for every $100 of their own money they invest into the business, they generate almost $25 in pure profit. The immediate trigger for future growth comes from their recent IPO. Lumino is taking over $50 million from that public offering and using it specifically to wipe out their existing corporate debt. The math on this is straightforward. By erasing that debt, they immediately stop paying heavy interest fees. That single move bumps their net profit margins up from 7.8% to an estimated 9%. Paying off that debt acts like removing a massive anchor. The revenue they are already making will instantly generate significantly higher cash flow for the investors. Lumino is in the path of a major national shift, India's goal to generate 500 gigawatts of renewable power by 2030. To support this, the government has launched a national grid modernization program, backed by over $36 billion in funding. This ensures a multi-year cycle of spending on the exact cables and substations Lumino provides. We can see that national spending directly in Lumino's books. They currently hold a guaranteed signed order book worth over $370 million. Lumino doesn't have to guess if customers will show up tomorrow. They have a massive multi-year waiting list of buyers, funded by government-backed infrastructure upgrades. Every business has operational risks. For a company making miles of wire, the biggest threat is a sudden spike in the cost of raw materials, specifically aluminum. They manage this risk by using contracts that act like a floating price tag. If the global cost of aluminum goes up, the price the customer pays automatically adjusts to match, ensuring Lumino doesn't lose money on the deal. The second major headache is the slow legal process of getting permission to build over land belonging to thousands of local landowners. Lumino bypasses these delays by deploying prefabricated modular substations that can be dropped into place quickly, and by using those drone surveys to find paths around difficult or disputed terrain entirely. Evaluating a strong investment isn't about finding a magical company with zero risks. It's about finding a management team building systemic guardrails to neutralize risks that do exist. Finally, we have to look at the price tag. Investors measure this using the PE, or price-to-earnings ratio. Think of it simply as the cover charge you pay today for the right to own $1 of the company's future profit. Right now, the average company in this industry trades at a hefty 32.5 times its earnings. Lumino, however, is priced much cheaper, at just 12.48 times its earnings. This chart shows the final institutional scorecard. When you grade Lumino across business strength, financials, management quality, and valuation, every single pillar lights up green. As always, this case study is strictly for educational purposes, to help you evaluate businesses, and it does not constitute direct financial advice. Consistent profit growth paired with a heavily discounted valuation creates a highly compelling setup. The raw numbers tell a clear story. Let me know in the comments which sector you want us to analyze next.